Hello and welcome back. In an earlier video we talked about knowing when to trade and when to stop trading. We talked about the best times to trade, and we also talked about a dynamic profit-taking strategy called power of quitting. Basically, the best times to trade we find are early in the trading session, depending on your instrument. Power of quitting, our dynamic profit taking strategy, says that when we trade, instead of having fixed profit goals, X number of dollars or Y number of ticks, we have dynamic goals. And we define power of quitting most of the time as having 2 winning trades at least and a net positive result. Now, there are occasions when we will not pursue the normal power of quitting goals of 2 winning trades and a net positive result. One of these is a good reason. Another is a protective reason. So we'll talk about one and done first of all. What happens on occasion is when we start our trading, the first trade of the session is a huge winner. And we can see an example of this right here. We typically start trading the heating oil futures at 850. So here we had a setup. It came a little bit before 850, and it triggered in right at 850. It went short, and this is a multiple position trade, where our first position we trade to this fixed target, which was right here, and then our second position we just trail. We use a trailing stop, and then we get out when the stop was hit. Now in this case we made roughly 40 ticks on the fixed target, but notice we made a lot more, actually about 140 ticks on the trailer. When this happens, we consider calling it a one and done. By using our power of quitting strategy, we find that on average, when we have a winning day, it takes on average 3 trades to have our power of quitting result. That means 2 winning trades and 1 losing trade. So oftentimes what will happen is the first trade of the session is a losing trade, but then the next 2 are winners, and you have a positive result, so you stop. Or sometimes your first trade is a winner, a modest size winner, and the second trade is a loser, and finally the third trade is another winner, which brings you into a net positive position. However, when the very first trade of the session is a big winner, we stop. Why risk throwing away, in this case 180 ticks, why risk throwing it away if we know that on average we're going to take only about 3 trades? And with a power of quitting strategy, we're only looking for 2 winning trades. So in this case, you can see that the very next trade ended up being a 1-tick winner. Our stop moved up right there. We didn't get to full target, but we stopped out essentially at break even. And the trade after that was another partial winner. We went short here. In this case, we actually did get to the full target. But again, you know, the second trade for our full power of quitting would have given us just a very small, after figuring in commissions and slippage, it might even have been a negative result. So again, if your first trade is a big winner, call it quits. The trading gods have given you a gift. Just take it and turn off your monitor and go golfing or whatever you like to do. We call this one and done. Now the question is, when do you consider a trade to be big enough for a one and done? Well, one strategy, and something that we do in our own trading, is when you're trading multiple positions. Typically what we'll do, like here, we will trade one position to a fixed target. So the first position will exit at a predefined exit point target. The second one will trail. The strategy we use is when the trailing stop is at or beyond the value of the fixed target, we call that a one and done. So in this case here, you notice the trailing stop right here is at the same price level as the fixed target, and then as it goes on, it's well beyond. As soon as we got to this point, we consider this a one and done. That is a larger than typical trade, and we're not going to push our luck beyond that. If you consider this short trade right here, you'll see that even though this trade also reached its fixed target, and let me just draw it in right here, even though this trade also reached its fixed target, the trailing stop was well above this fixed target. So we would not have considered this as a large trade. Had this been the first trade of the session, we would not have taken this as a one and done. Instead, we would have continued and taken the next trade after it. All right, so that's the one and done strategy. And all it says is if the very first trade of the day is larger than typical, then stop right there. Okay, if you had a big winner, stop right there. If you're trading a strategy that uses a single position, it gets a little more complicated. So if every trade has the same size, then you would not be able to use this type of strategy because you wouldn't know what's a larger than typical trade. If you use dynamic targeting, as we do with this strategy, you'll notice the targets vary based on the setups, and some of them are very close, while others are farther away. What you can do is do a back test, which you should have done anyway. And here I'm just going to show you a sample back test. Do a back test and do a statistical analysis. Do a statistical analysis on your winning trades. So here you see we have winning trades 1.8 points, 1.2, 1 tick, 5.7 points, 2.8, etc., etc. What you would do is you can use some of the statistical functions available in your spreadsheet, for example, average, and you can calculate the average winning trade size, and you can calculate a standard deviation. Now, I've done the analysis on this spreadsheet, and I know that the average winning trade is 1.1 points on the Russell. That's the average winning trade, 11 ticks. I also know that one standard deviation in this sample is 1.7. All right, so what this tells me is that about 15% of trades are going to be greater than one standard deviation above the average. So if you take the average 1.1, you add the standard deviation, that gives you 1.1 plus 1.7, 2.8. What this says is that only 15% of trades will be larger than 2.8. And that gives you a point at which to cut off. So what you can say is, I'm going to consider any trade that's larger than 2.8 points on the Russell to be a large trade. And if my first trade of the day yields 2.8 ticks or more, I'm going to stop. If you want to be more selective, you can use, instead of one standard deviation, use two standard deviations, which would tell you, anything above the second standard deviation, only 2.5% of all trades will fall in that area. Alternatively, if you don't want to get fancy and use statistics, just sort all of your results from highest to lowest, and then just count off and see the 10% highest winners, where's the cutoff. So in this case, I probably would have 5.7 at the top, followed by 2.8, followed by 1.8, 1.7, etc., etc. And if I were to look at the top 10 winners, top 10% of winners, the cutoff might be at, let's say, the 1.6 or the 1.7 level. Right? So different ways to do it. Or you can guesstimate. That's always an option. So again, when we do the one and done, if it's a multi-position trade, we look for the situation where the trailer is equal to or greater than the fixed target. Anything that meets that criterion, we consider a larger than usual trade. If it's a single position trade, you can just look at anything that's one standard deviation above the average winning trade. The next thing we'll consider is the circuit breaker. And circuit breakers are there for protection. Now what a circuit breaker will do is you'll define a level of your account. If the losses, the daily trading loss exceeds that level, then you stop trading. And for example, what we've been using is $600. All right? Based on our account size, we decide that a loss of $600 is about as much as we want to take in any trading session. Now here we have a chart of the RB, and on the RB, one tick is worth $4.2. And that says that if you have a total loss of 143 ticks, that's $600 loss. Okay? So if we get a loss of 143 or more ticks, we stop trading. And the reasoning is, we know that the best trading is early in the trading session. If we get into our trading, and if we are faced with choppy trading right away, then that probably means that this is not a typical session, and that price action will continue choppy for a while. And if we continue trading blindly, we'll just dig ourselves a deeper and deeper hole. And you can see that happened here with RB. This was on the 24th, where the first two trades we took, represented by the vertical lines, were both losing trades. And after these two trades, we were down in our account by 154 ticks. That's roughly $630 or so dollars. So we hit our financial circuit breaker and we stopped trading. And it's a good thing too, because after that there was another losing trade. There were a couple of break-even trades, but then another loser right there, another loser right there, and then finally, eventually, at around 10:40 in the morning, we saw some more positive trading. All right? But by using this financial circuit breaker, we kept ourselves from digging a deeper and deeper financial holes. So that's one type of circuit breaker, and the other type of circuit breaker we use is time. And what we do is, every instrument that we trade, we only trade it for a fixed period of time. Here we have a chart of wheat. Wheat, we actually only trade for 30 minutes. We trade from 10:30 Eastern Time to 11 o'clock. If we have a loss at 11 o'clock, we stop. Doesn't matter. Whether we win or lose, we only trade for that half hour, because we found that that half hour is our most productive, most profitable half hour. By limiting the time that we trade, we limit the damage that we can do to our account also. So here we see this happening. In this case, in that half hour period, this is Central Time, so 8:30 is actually 9:30 for us. That's when this trade set up. We actually managed to get in sync with it later on in the session. There we go, right here on this bar, because price pulled back, giving us an entry. So this was at 10:30 New York time, and we had a nice winning trade. And once 11 o'clock, which is 10 o'clock Central Time, came by, I was right there, we stopped trading. And as you can see, had we kept trading, we would have had, another loser here, losing trade there. This would have turned into a losing trade. So we saved ourselves from digging a deeper hole. So here we also, as it happens, we also have a one and done situation. The stop, it's hard to see because of the color, but the trailing stop for the second position moved to this price level right here, which you can see is above our fixed target. So that was also one and done. which was the actual reason for not trading anymore. So those are the two conditions we like to use, and we always use our power of quitting, but we will modify the basic power of quitting rule of 2 winning trades and a net positive with the one and done scenario, where the first trade is a big winner, bigger than average, and the circuit breakers, of which we have two kinds. A financial circuit breaker that limits our maximum loss in terms of dollars, and a time-based circuit breaker that limits the amount of time that we're actively trading. Thank you for your attention, and good luck in your trading. Bye-bye.